Yeah.
Thanks for joining us, Piers, and I'll leave you over the stage and for your talk.
Sorry, everybody. So first of all, thanks to Agency Growth Events for the invite. Ozan, if you could enable the screen share, I'll move on to that quite soon. So just a couple of words on why Barish has asked me to be here today. I'm an entrepreneur, an investor, an advisor with my own advisory business. My background is media, so I'm not agency background like many of the people on the call today, and I'm not a brand marketer. I'm an events, media, information business entrepreneur. So I've built and sold 3 businesses, worked on many transactions, and we also host a media entrepreneur meetup. So Ozan, can you enable screen share? Thank you. Perfect. With nearly 400 entrepreneurs from around the world who are members of it. So that kind of gives us a clue into what media entrepreneurs are thinking. Ozan, can you enable my one? Perfect. Thank you very much. And whilst I'm not a brand marketer or an agency person, in media, we got the first party data, so it's worth having that conversation. So what we're going to talk about today in just 15 minutes is 2 interconnected things. One of them is scaling your business and working out how to exit the day-to-day, which is an inevitability because death and taxes are inevitability, and both of those things will drive your decision to exit. And creating value, and I'm going to explain exactly what I mean by that. Ozan, I think my screen share is gone. Could you restore it? Thank you very much. So we're going to talk about what is value creation, your scale-up journey as an entrepreneur, your long, slow exit, and the value leaps that you're going to need to take in order to make this happen. So there's what the strap line that I agreed with Barris was working on your business, not just in it. And that's crucial. You'll all have heard that phrase, and we've got a lot of bruises from working out how exactly to do that in owner-managed businesses. So what do we mean by value? Often people are narrowly fixated on financial value, but financial value, enterprise value, is really an output of multiple layers of creativity that you're going to go through as an entrepreneur. So in many cases, it's just about product, right? So what is product? It's when you start to build customers. Many entrepreneurs stop at building a business, which is the point where you start to generate profit and loss. In our business, in our M&A practice, we look at asset value. So sustainable, predictable profit growth creates enterprise value. And that's what most people talk about when they talk about value creation. However, especially in the agency world, in order to create asset value, you need to do something more profound, which is to build a great company, build a great culture, something that will survive your absence, and something that, and this is the 5th layer, has intrinsic value to its community and maybe wider in society. So when we talk about value creation, we're kind of talking about all those things, with the asset value being an output. We talk to literally hundreds of media entrepreneurs every year, and they're not unusual in creative businesses and in services businesses, where capex to get going is often relatively low, and therefore a lot of the challenges that are gone through are quite personal and quite management oriented. So these are 6 of the typical challenges we see when we're talking to business owners. Let's talk about scale up. What do we mean by it? And this graph is particularly appropriate to the media business in which we work. So we found that there are some kind of inflection points, glass ceilings that businesses stop at. So the first one is getting past the startup stage, where you're just talking about product, you're just talking to customers, you're right in the middle of the business. And in the UK, that typically takes you to somewhere between £500,000 and £1.5 million turnover in media. So in the US, that's about $2 million turnover. That's the maximum point for many companies where the founder can directly control many of the processes of the business. To get through that and to move into the high growth phase, they have to do your first level of delegation. So there's kind of a personal journey that's got to be gone through. And often there are some kind of mythologies in the business about glass ceilings. This is as far as it needs to go. It's all about quality, not about quantity. As advisors, we often spend time with people kind of prizing open those mythologies and seeing where the scalable opportunity lies. If you can get past, and this is the next inflection point, around £3 million turnover, $4 million US turnover, somewhere around there in the media space, something interesting starts to happen. The company starts to take over and tell you what it wants to be. The way you govern it, and we're going to come to that, becomes more collegiate. You involve other people in decision making. There's more professionalism in the way that you manage and report the business. And in particular, there's more discipline and predictability starts to get introduced in your go-to-market, your sales and marketing, your delivery and your retention strategies, and particularly in product development, which can be a bit of a bugbear in the early stages. In creative industries, there's a tendency to create too many revenue lines, product lines, innovations, because it's creative risk takers who start businesses. But in this phase, the scale up phase, you start to churn those people from the outset of the business who are kind of startup adventurers, and to hire people who are more corporate, more about predictability and marginal gains. In our sector, a lot of companies exit at this stage. So between 3 and 10 or 12 million turnover in pounds, between 4 and 12.5 or 15 in US dollars. Why is that? Because at this stage, assuming you tick some of the boxes we're going to talk about shortly, people are going to offer you a 7 or small 8-figure sum. And that's perfectly legitimate as a time to exit and enter into a new era of personal and financial security. But there are some companies, challenger companies, who want to define a sector, and they will go on to become platforms. Now, a platform can be a vehicle for private equity investment. It can also be a company that starts to take on debt, maybe third-party private investors, in order to fund inorganic as well as organic growth. And in order to do that, you have to become much more like a corporation and really either become a professional CEO yourself as the founder, or hire someone who is and negotiate a succession plan. And that's generally what happens. So what do you need to do to scale internally? So we've got a thing called a value creation plan, where we look at about 20 predictors of future value. Some of those kick out a score, like the scores you see here. And the things that we think are really interesting in terms of predicting that future value of your business, and we are talking about enterprise value now, are market leadership. So that's about market share, thought leadership, brand awareness, trust, relationships, knowledge. Go-to-market organization. So, most companies, when they start out, the sales are quite top-down driven, they're quite relationship driven, and over time they need to become more predictable. And there's a lot of work that's been done in the SaaS industry about creating predictable bow tie type funnels using inside sales, inbound marketing, and so on. Governance and approach to people and process. Absolutely not essential to get to high growth stage. To really scale, this becomes a crucial thing. And again, there's often a contradiction between the creativity of being a business founder and the predictability and rhythm of having a proper governance. The other thing, and this is much more familiar, is about innovation and product management. I've said product management rather than product launch, because most founders in our sector are quite attracted to launching new products, because it's often quite easy and less boring than getting marginal gains. But the reality is, to create a business of scale, you need your biggest products and product suites and market presences to scale. And that's about having predictable product management, predictable new product development processes, and a rigorous approach to validation and launch. So your long, slow exit. And unfortunately, some of these things are a bit of a metaphor for the shortness of life. On the left, you see where you start as a founder. You're in the middle of everything: your team, your stakeholders, your customers, your products. What all successful businesses end up doing is migrating to the right-hand structure. And that's not an org chart, it's an accountability chart, where there's owners, there's a board, the board delegates management to a management team, and then there are functions below it. If you look at the top of each of the 3 pyramids, that's the interesting thing for the owner. It is legitimate for you in your scale-up phase to spend time working on the qualitative, creative aspects of each of those functions to be a participant. But it's not legitimate for you to bypass your management team and do that work directly. So there are still roles that you can play as a founder. That can mean just being a board director. They can also mean driving IP or business development, or in some cases it means going into inorganic growth and doing M&A. But whatever happens, you're going to pop yourself at some point out of your management team onto the board and into that owner director type role. I love this phrase, governance is your friend. I don't say it because I love being governed. I find my own board meetings excruciating in the level of accountability and detail. But the point is, if you want to create a business of scale, the predictability of process, reporting, an objective board culture, and clarity of roles in terms of strategy and governance is absolutely crucial. So on the top, you've got the kind of classic Rockefeller habits, meeting and reporting with them that keeps you close to the front line of the business. And below, you've got looking at how you start to separate the different roles that you might play and that others might play in your business. Final point, I know we've got a relatively short session today. Value creation goes in leaps, right? So we looked at the inflection points before. There are points where you have to get much, much more serious and corporate about the way that you generate enterprise value. So it's sort of an x-axis and a y-axis. On the x-axis are things that are quite intuitive and easy to understand. There's stuff that happens in business as usual. How do we get more out of that person? How do we hire more people who are selling? How do we maintain control of our costs? They're kind of logical, common sense things. The value drivers, the things that drive the multiple that's paid of your revenue, or more usually your EBITDA, or your profit before tax, or free cash flow, they're all about kind of long-term, sometimes quite counterintuitive elements that feed into quality of earnings. Fundamentally, what investors who ultimately buy your business want is predictability, embeddedness, and a lack of volatility in your earnings. And so that's why we focus a lot in our work on process, governance, strategy, and the simplification of the business plan. So that's what we call smart value creation, is thinking about ways to create intrinsic and enterprise value and having a defined multi-year process for letting go. And I think this theme of letting go is really important in management and entrepreneurship these days. So thank you all for listening. It was a pleasure to be